Nike just reported a 407% jump in quarterly profit. Here's the strange part. Almost none of it came from selling shoes. It came from a courtroom. This is Nike's fiscal 2026 10K, the year the turnaround was supposed to hit bottom. The question is whether the floor is real or whether a one-time windfall is hiding a business that's still shrinking. Let's dig in. Start with the top line. Nike peaked at $51.4 billion of revenue in fiscal 2024. Then it reset. Hard. Fiscal 2025 came in at $46.3 billion, and fiscal 2026 finished at $46.4 billion, flat year over year, and down 2% once you strip out currency. $5 billion of annual revenue is simply gone, and some of that was on purpose. Nike says it pulled more than $2 billion of classic lifestyle franchises out of the market to clean up distribution. Now the courtroom part. In February 2026, the Supreme Court ruled that tariffs imposed under the International Emergency Economic Powers Act were unauthorized. Nike had been paying those tariffs all year, so in the fourth quarter, it booked a $986 million recovery, a one-time benefit that landed straight in cost of sales. That single item was worth roughly 9 points of quarterly gross margin, and 52 cents of the 72 cents Nike earned per share. So here's the honest margin picture. Reported fourth quarter, gross margin, 49.2%, up almost 9 points. Underlying gross margin, excluding the refund, 40.2%, down 10 basis points. The full year tells the same story. 42.9% reported becomes 40.8% underlying, and earnings per share of $2.10 becomes $1.58. Margins haven't recovered yet. They've just stopped falling. Underneath, Nike is two different companies. Performance is genuinely working. Running has grown double digits for 5 straight quarters, adding about $1 billion of revenue and 5 points of market share. Wholesale grew 6%, and Nike's Foot Locker business comped positive for the first time in 4 years. But lifestyle, sportswear and Jordan streetwear, roughly half of revenue, is still shrinking. Nike Direct fell 6%, with digital down 12%. Management says lifestyle stays negative into the back half of fiscal 2027. Geography tells the same split story. North America carried the year, up 5% to $20.5 billion, with segment earnings up 14%. Europe, Middle East and Africa grew 3% reported, but shrank 3% currency neutral. Greater China fell 11% to $5.8 billion, with earnings down 20%, and Converse collapsed, down 31% to $1.2 billion. The 10K says it plainly. China and Converse headwinds persist throughout fiscal 2020. 7. One number to sit with. Converse earned $240 million of segment operating profit in fiscal 2025. This year, $18 million, down 93%. Nike is resetting the brand around Chuck Taylor and Jack Purcell, and it just moved basketball star Shai Gilgeous-Alexander over to Nike Basketball so Converse can focus purely on lifestyle. But for now, a brand Nike bought for growth has become a rounding error. The cash story is where discipline meets strain. Inventory held flat at $7.5 billion, genuinely impressive while sales fall. Nike holds $9 billion of cash and short-term investments against $7.9 billion of debt. But operating cash flow fell 22% to $2.9 billion, and free cash flow, about $2.2 billion, no longer covers the $2.4 billion dividend. And buybacks all but stopped, $123 million this year versus nearly $3 billion last year. Nike is spending down flexibility to defend its dividend streak. Guidance keeps the pressure on. Management expects revenue down low to mid-single digits over the next 6 months, with the second quarter facing a multi-point headwind from last year's comparisons. Gross margin is guided to inflect positive in the first quarter, and new tariffs are assumed at 10%, rising to 15% after July. One more wrinkle: a new chief financial officer. David Denton arrives from Pfizer in August, and incoming finance chiefs have a habit of resetting guidance low. So, what is it worth? At around $44, Nike trades at 20 times reported earnings, but 28 times underlying earnings once you remove the refund. Our discounted cash flow range, roughly $20 a share in the bear case, 38 in the base case, 59 in the bull case. A peer re-rating on normalized earnings points to $44 to $66. Notice what that means. Today's price is already above the base case. The market has prepaid for a recovery that hasn't shown up in a single reported quarter yet. And to be clear, that's an implied value range under stated assumptions, not a price target. This entire analysis was built using RoboSystems, a platform that gives you direct access to structured SEC filing data for every public company. Revenue, earnings, balance sheet, cash flow, segment breakdowns, all queryable, all from the original XBRL filings. If you want to do your own deep dives like this one, head to robosystems.ai, link in the description. Here's the bottom line. Fiscal 2026 looks like the engineered floor. Revenue flat by design, underlying margins stable, inventory clean, and performance product genuinely working. But the headline profit was flattered by a one-time courtroom win. The dividend is running ahead of free cash flow, and half the business is still shrinking. Watch three things: whether margins actually inflect in the first quarter, whether the sportswear relaunch lands in the back half, and what the new Chief Financial Officer says at the November Investor Day. The floor is probably in for the business. Whether it's in for the stock, that's the bet. Thanks for watching.